You are setting up a new financial account on your phone. You see the words money market and you immediately hit open. But choosing the wrong product means your emergency rent money might be tied up in an uninsured mutual fund, or your dedicated investment cash gets stuck in a bank account with strict monthly withdrawal limits. A simple vocabulary mix-up places your cash in the completely wrong financial ecosystem, right at the exact moment you need it. Now, this is a highly practical distinction. It determines whether you can actually access and spend your own money during a sudden crisis. To understand why, look at how they are branded. Both the money market account and the money market fund sound identical. They both promise stability, and they both pay you a yield. But underneath the surface, they have entirely different financial DNA. One is a highly secure, government-backed bank vault. The other is a fast-paced staging area on Wall Street. Because of this structural difference, you can't use them interchangeably. You have to match the specific product to what you actually want your cash to do. Let's look at a money market account, or MMA, through a practical example. Say Alex deposits $5,000 into an MMA at a traditional bank. Right away, Alex gets real-world utility. The bank issues a debit card and check writing privileges, making that cash instantly spendable. More importantly, this setup comes with an absolute safety net. Because the bank is federally insured, that principal balance will not drop. If the market crashes, Alex still has exactly $5,000 plus any interest earned. The trade-off for that security is friction. Banks typically limit you to 6 withdrawals per month. Plus, the interest rate you earn is dictated by the bank, which means it might lag slightly behind raw market rates. So Alex sacrifices a tiny bit of potential yield to gain absolute sleep-at-night safety and direct purchasing power at the grocery store. Compare that to Jamie, who takes $5,000 and opens a money market fund, an MMF, inside a brokerage account. Jamie isn't making a bank deposit. Jamie is buying shares of a mutual fund that invests in short-term government and corporate debt. Because of this, the dividend yield reacts almost instantly to changes in Federal Reserve interest rates. The primary advantage here is positioning. Jamie's cash is perfectly staged, ready to deploy into stocks the second the market looks favorable. This chart illustrates the hidden risk. Money market funds aim to maintain a price of exactly $1 per share. But because these are investments with zero FDIC insurance, extreme market stress can cause them to break the buck, meaning that $1 share price cracks and drops, taking a fraction of your principal down. Jamie is willingly giving up government insurance and immediate spending capabilities to keep that cash optimized for aggressive investing. Let's put both of these strategies through a real-world test. A year goes by, and Alex and Jamie both get a $1,000 car repair bill. For Alex, it's frictionless. He swipes the money market debit card, paying instantly. Jamie faces a hurdle. Because her cash is in a mutual fund, selling shares triggers a 2-day settlement delay. Even after that trade finally settles, the cash is still sitting inside the brokerage. Jamie then has to initiate a transfer from the trading app to a standard bank account before the mechanic can actually be paid. In a practical sense, prioritizing yield and investment staging means you are actively accepting a 48-hour delay to access your own money during a crisis. This flowchart shows the ultimate rule. Your choice depends entirely on the timeline and purpose of your cash. If your goal is building a 3 to 6 month emergency fund, saving for a wedding or a house down payment, you follow this path to a money market account. You are explicitly sacrificing a tiny fraction of potential yield for the ironclad guarantee that your money is safe and instantly accessible. Conversely, if you have cash in a trading app and want to wait out a shaky market before buying stocks, your path leads directly to a money market fund. Here, you accept the lack of FDIC insurance to earn higher dividends, keeping your capital one click away from the stock market. You don't have to guess. By matching the product to the ultimate destination of your money, you eliminate the risk of walking into a liquidity trap. Understanding this minor vocabulary difference goes a long way in preventing serious cash flow mistakes. Now that you know where to put your savings, the next logical question is exactly how much cash you actually need in that emergency fund. We break the math down in our next video. If this breakdown helped clarify things for you, take a second to subscribe to the channel so we can keep helping you build your financial toolkit. See you in the next one.